Okay, so good morning, everyone. Welcome to the new week. This is the macro snapshot. We are Monday, February the 10th, 2025. Okay, so let's have a quick look and see what's going on. Obviously, over the weekend, we had some more comments from our friend Mr. Trump threatening today to impose tariffs on sort of steel and aluminium imports coming into the US, also threatening the imposition of reciprocal tariffs sometime later this week. But basically, what's happened at this point is that the market is sort of saying, okay, Trump, you're a lot of talk at this point. Your bark is worse than your bite. And so the market, what we're seeing is that the market reaction, we are still getting spikes, but they're very short-lived. And just to give you a sense of that, if we put this, let's say, on a 3-minute chart, and let's look last night, we know that, for example, a country like Canada, it's one of its major exports from Canada into the US is steel and aluminium. So this is very negative news for the Canadian dollar. But let's say, for example, we look at USD CAD, we can see that on the news, which came out just over the weekend, we can see that the US dollar gapped higher, which you can see here. So the US dollar did gap higher about 50 or 60 basis points. But then after, 10 minutes or so, what's that, 10, 12 minutes, basically started to drift back down. So the US dollar is a little bit stronger against the Canadian dollar, but nothing, too severe. We can also see the same reaction if we look at the stocks. We see that, for example, the S&P 500 gap down, and then literally after 2 or 3 minutes had closed that opening gap and is now sort of pushing a little bit higher. Some of that, of course, is the anticipation that steel stocks, domestic steel stocks in the US will be stronger. But you get the point that the market really is saying, okay, Trump, show me the money at this point, or show me the tariff. And I think what we're starting to see, and this is a bit of a more general overview, is we're starting to see a little bit of annoyance or skepticism at what Trump's doing by the market. And that's just because I think I think there needs to be some concrete progress by the Trump administration relatively soon. I mean, basically, if you look at some of the main planks of Trump's sort of program, let's, for example, look at immigration. I mean, we assume there's going to be some deportations, and we can assume there's going to be less people coming in. I mean, at the end of the day, that's going to make the labor markets a little tighter, and that's going to be a drag on growth. Okay, so tighter labor markets drag on growth because, immigrants create a little bit of growth, and it's going to be slightly more expensive for labor. Secondly, if we look at tariffs, we don't exactly know what's going on. That it's unclear, but the trend of direction of the travel is very clear. That it looks like North America, but also the world will have more tariffs, and there will be some retaliations. There's going to be less efficient global supply chains. There's definitely a lot of uncertainty, and this is going to be less growth and probably less immediate investment as investors and sort of business leaders wait for clarity. So if we look at immigration and tariffs, you've got to say that at the margin, some of these are, quite bad for growth in theory. Then we look at the budget situation, the deficit. Now we know that Doge and Musk and everyone, they're trying to sort of cut costs if possible. But the reality is, even if they're successful, doesn't that imply less spending and less headcount, less employed people from the US government? And that too is bad for growth. There's less growth there. And we also have the idea that, if there's less employment, there'll be less income, so probably more bond issuance. So what I'm trying to say is that if you look at cost cutting and deficit reduction, if you look at tax cuts, if you look at tariffs, and you look at immigration, we're getting to a point where a lot of those things are not really great for growth. If anything, they're sort of negative for growth. And so the point is that I just wonder, looking, let's say, go back to the daily on the stock market, you start to see something like the ES, which has been trading in a range. And is this a topping formation? Because I think the market, and let's say the stock market, is basically saying, hey, we're spending a lot of money on AI capex infrastructure. We need to start seeing some of these big companies monetize that. Trump has, upset, let's say, the labor market and immigration, cutting headcount and spending, and putting on tariffs potentially in one shape or another. All of this stuff is sort of a negative for growth. And if we don't see some sort of concrete benefit soon, we being the market, I've got to say that the market could start pricing in less growth for companies, less growth for the US economy, and ultimately some kind of, I don't want to say a major recession, but some kind of slowing of growth. Now, on the other hand, we've got Besant who's saying, no, 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 don't worry. That's all the kind of short term, a little bit of pain. We're going to do the 3-3-3. We're going to drill more oil. That will bring the cost of energy down. That will bring down inflation. We will continue to have tax cuts. There'll be a lot less regulation. All of this is pro-growth. So I have to say, I think the market at this point, it's reflected in the price action. It's just bouncing up and down in this strange range. And it's trying to understand whether Besant's vision will occur, or whether a slightly more sort of pessimistic, negative growth scenario will actually take place. And I think Trump, to be honest, is not helping himself with this uncertainty and just the threat of tariffs, because that's creating, there's been a lot of CEOs coming out saying that it's impossible to make investment decisions in the current environment. So that's kind of the big picture thing, which we need to be looking out for. But as I say, if the tax cuts remain in place and there's less regulation, for sure, that could be a positive. But balanced by that is these other issues which could be a drag on growth. So let's just look a little bit what's happening. It's not a huge amount of data today. One thing we just did get this morning, which is actually quite a useful little survey, historically quite well correlated. We have the NFIB small business optimism, which had been pretty positive, but we see here a little bit still, quite high, 104.7, but a little less than last time. So again, this whole issue of companies, the initial flush of excitement with Trump, it's starting to say, hey, this is a bit chaotic, and we don't really like exactly what we're seeing. We want to see more concrete steps about, sort of cutting regulation in an orderly fashion. We shall see. Okay, so just looking at some of the markets, what I want to look at, let's say, for example, the dollar. So we know that on the announcement potentially of tariffs on steel and aluminium, the dollar quite like that. And we'll have a look at the dollar index. But I think the dollar here is trading in a range. I think it's reasonable to think that it could get up to, let's say, this 109 and a half kind of level, this trade range here. And I think on the downside, around about 107-ish, maybe 106 and a half down to this low here. I think we're basically going to be in a trade range. Reasons for the dollar to come off is simply this idea, if we look at the bonds, I mean, what is Besant trying to say? Besant, the Treasury Secretary, was very clear last week on, I think, 2 or 3 occasions, and he said that Trump is, in agreement with him. They're not targeting the Fed funds rate. They're not targeting the Fed funds rate. Powell can do what he wants. What they're doing is targeting, he said, the 10-year and the 30-year yield, and they want that to come down. They want the curve to flatten. They want the cost of financing for real business projects to come down. And that's most dictated by, let's say, the 10-year as the global benchmark and the US benchmark. But if that's the case, a lot of things have to happen. Like if they do get that down, we'll see a curve which is a bit flatter. We're also going to see a dollar which potentially, this is my point, potentially will be under a little bit of pressure if we start to get those differentials with, let's say, Europe and Japan coming in. But I think, so if we look at some of those differentials here, we can see, where are we? We'll look at, let's say, the US 10 and the German 10. You can see at the moment that they had gone up a lot in September in favor of the US yield, so a lot more. They've come back down, having a little bit of a fib retracement here. The real question here is whether this will sort of go out a lot more. If we look at the European situation, I don't know that they can go particularly a lot more, to be absolutely honest, just because I think, we're steady. If we look at, let's say, the German, what have we got here? Let's say like the German 2-year, for example, I think it's going to be steady. It could get down to 1.9, maybe up to 2.2, but I think that's going to be basically in a range. I mean, it's unlikely that we get higher yields because the European economy is not exploding or really expanding too much. So it's unlikely that we get very, very high yields here. But on the other hand, we have to say to ourselves, the ECB is on a relatively dovish path. Will the ECB cut a lot more aggressively and push these yields down lower? So I think the answer there is no. So I do believe that in the 2-year yield in the German space, probably this high here of, let's say, about 2.3 will probably be a high, and down below maybe let's call it 1.9. So we're going to be trading here, I think, in a 20 or 30 basis point range. And that implies that if we go back and look at the differentials here, that we're not going to see a huge amount of change in the differentials. But it's certain that someone like Besant, he wants to flatten this. He definitely wants this to come down. He'll probably want it to come down, certainly to like 2%, but even more like sort of down here somewhere at 1.85, 1.8. He wants this differential to come in. So the point here is that if he achieves that, how would he achieve that? By trying to get all the pressure to go downwards on US 10-year yields. He's told us that he doesn't want to issue too much more at the auctions. But again, that's going to be subject to the deficit. So what's happening at the moment is that Trump and Dissent are trying to have their cake and eat the cherry. They're trying to say, we're going to keep tax cuts, we're going to reduce the deficit, we're going to reduce yields, we're going to reduce inflation, we're going to reduce regulation. But that assumes that these tax cuts will be funded by essentially more economic growth. We shall see. But just to say that I think getting back to the currencies, that the US dollar, I don't see it ripping particularly enormously high, as I said, in this 109, and I also don't see it collapsing. So really what we're going to have to see is sort of action, let's say, over in the euro space. Again, the euro, I mean, you got to say here that the euro possibly, I think it's going to be in a trade range. It's going to be difficult. I think anything up at 105 would be probably a short. And I think, it definitely could retest these lows here. So you'd be shorting up here at 105, probably trading in this range. The interesting one's the yen, which just gave a little bit back to the US dollar just overnight, just on this tariff news here. But at this point, as we've discussed, I've got here a potential future path. We'll see if that plays out of the USD yen. It wouldn't surprise me again if it rallies a little bit, maybe here, maybe a little bit higher, but ultimately the US dollar weakens against the yen. And that's just because we know that ultimately to make America more attractive for manufacturing and for exports, the Trump-Bessent duo, they need a softer US dollar, a little bit softer, even though Bessent the other day said he doesn't mind it being strong and wants it strong. If we believe that 10-year yields lower is what they're aiming for. And over in Japan, they do have inflation, they have strong wage pressure, and they have a BOJ which should be doing one or maybe even two hikes, not cuts, hikes later in this year, compared to the Fed, which is still on course to cut once or possibly twice this year. So we should start to see those differentials actually coming in closer, in the sense that the US 10-year should get closer and closer as the Japanese 10-year yield rises. So all of that to say that should put downward pressure on the USD JPY at some point. Not to say that we can't have some squiggles in the meantime, but I think ultimately the direction of travel here is maybe down towards, let's say, 150. Also, Euro JPY. I think, if this can break some other levels, let's say 154, this is got some big levels coming up here. It's like a quadruple bottom. If it could break down here, you can see that, there is more downside. If you look historically here, this guy could get down to, maybe 143 longer term, all the way down here. And that's just based, again, on the fact that, Japan seems to have escaped the tariffs. There seems to have been a pretty good meeting last Friday between Trump and the Japanese Prime Minister. We just spoke about the monetary policy direction in Japan. And we know that Europe, at the end of the day, the ECB is, on a cutting cycle, and the European economy is, sort of steady at best. So I think ultimately what we might see, we'll probably see a pretty big battle down here, some kind of big battle all along this sort of area here, about 154, 155. Maybe it will bounce a little bit, but if it goes down there, then I think, in probably the second half of the year, we could get down into the 140s. So definitely want to be selling rallies. In terms of a couple of other currencies here, we just spoke about CAD. CAD's still under pressure here against the US dollar, because we know we had that 1 month reprieve last week. But the reality is we see how sensitive it is. Any kind of imposition of tariffs or anything is going to be very negative for the Canadian dollar. In theory, as we spoke about, there's going to be steel and aluminium import tariffs put on today. If that happens, I do believe that USD CAD could push up a little higher. We're also seeing some of the other commodity currencies. We see the Aussie dollar here actually under a little bit of pressure. It's come back, but it had been under pressure against the US dollar. We also see New Zealand. This is on the futures, just trading along the lows as well. So still these trade sensitive currencies under quite a lot of pressure. I'll just grab some tea here. Now, talking about commodities, it's interesting just to look. We can look at a general ETF here. Let's look at, let's say, for example, what's it called? GSG, which is like a general commodities. I think about 55, 60% energy. So quite heavily weighted in the energy space. But you can see here that that broke out, but it's just been sort of trading sideways for a little bit. But so the question really here is this going to break out, on some kind of China stimulus, on a lower weaker on a lower dollar, and it's difficult to see. What is interesting though is to look at just the relationship. I want to put it, let's say, with gold. So let's, for example, put just see the relationship here of gold. Let's see if we've got whoops. So what I want to do gold divided by the commodities. And you see here just how strong gold has been. So this is gold divided by GSG. So you see that within the commodity space, gold is really, really outperforming. It's outperforming a lot of stuff. So very, very strong here. And this is telling me really that, the commodity space itself is relatively flat, which also is telling us that we shouldn't have crazy global inflation. So gold is doing very well. And why is that? I mean, if I just put it on the spot gold thing here, we had a report over the weekend that the Chinese central bank is still buying a lot of bullion. They've been adding to their bullion sort of reserves over the last 3 months. There's also as an inflation hedge, even despite, and as possibly a slightly weakening US dollar inflation hedge. Just technically, we do have this large upward sort of channel. It looks a little bit parabolic, but the reality is that technically, things can remain oversold, overbought for a long time. And it looks to me as though possibly that could be the next target up here, which would be around about 29.50, 29.60, something up there. Certainly at that point, you've got to say it's looking very overbought. But what's also interesting, guys, and I just want to put this all into context here. I've just got a chart here. And what this is here is a butterfly, which is basically saying long gold, long the long bonds, the TLT, and short in the middle of the butterfly, the equities. And really what this is showing here is that gold is really outperforming the SPY. It's starting to outperform. You see it's starting to sort of to push up here, as are the long bonds. And so this is kind of interesting just to see here how equities are really starting to plateau a little bit. And I think equities, they have very high valuations. They really want to start seeing, at some point, some concrete benefits of Trump's approach to the economy. So this is one which I do believe has a bit more upside potential, maybe up to here. What's that, 820, minus 820 or so. But it's not so much to be trading this. It's really just to be looking here at the relative performance of, let's say, gold versus bonds versus stocks. And what we're seeing here is that if we believe that the US wants to get sort of the 10-year yields down, we have to look at the 10-year yields and say that maybe they don't have, a huge amount more of upside. If we can find that, let's say, the 10-year yield and the 30-year yield, I mean, it could go up a little bit more. And let's say we look at the 30, for sure, it could go up to somewhere up here. But it seems to me that we're probably going to be in a bit of a range now with this new sort of a directive or sort of a policy from Besant. Just in terms of a couple of other things, guys, might just leave it there. Oil, I just want to have a quick look at. Oil actually having a little bit of a breakout this morning. I'm not going to get too excited about it. It's up $1.37. No, it's a 1.37%, so about $1. But for the first time in a long time, we've had a reasonable sort of green candle here. Oil, the price action had been very, very disappointing. If we look at this fib here, or maybe even where the impulse sort of started, you can see that whichever way you cut the cookie here, excuse me, it broke down badly below this horizontal support and the fib level. And so you have to say, well, why is oil popping a little bit? It's popping because we've had quite a lot of cold weather in Europe. Nat gas prices are up. That means that comparatively, oil is becoming more attractive compared to sort of nat gas. So that's supporting it. We're also starting to see, especially in Indian refineries and in Chinese refineries, there's starting to be a little bit of a tightness in the market, in the physical market. Because of the sanctions on Russian oil are starting to cut in a little bit. And that's making the Russian oil a little scarcer. And therefore, what we saw over the weekend is that the official selling prices, the OSPs, for Dubai, for oil from the Middle East, from Iraq, and from the Saudis. I was just reading this morning, all of those grades of oil from the Middle East, they've substantially upped or raised their official selling price, the OSP, especially for refining in India and China. So the point is that those sanctions on Russia are starting to sort of to bite a little bit as they are on Iran a little bit. And let's see if Trump keeps those up. And because as that happens, we might start getting a little bit more tightening in the global sort of supply of oil, which of course has got to be at the margin a bit beneficial for WTI. The other issue, of course, as well, there's still uncertainty about the situation with Canadian oil, about 4 million barrels a day coming into the US from Canada. Steel and aluminium tariffs would also make oil refining more expensive. And so that's putting a bit of upward pressure on as well. Let's see. I'm not convinced that this bounce has legs. And to be honest, to be in any shape or form bullish, this has many, many hurdles. We could just illustrate some of the hurdles here. 73.20 would be the first one, then like at 50% at 74.77, then up to about $76. It's only really in my humble opinion, if we get above, let's say 76.25, that in any shape or form we can call any of this anything more than a technical reactive bounce. So we can't say this market's bullish at all. There's still a lot of work to do, probably about 400 ticks, about $4 before this gets at all sort of bullish. But for those of you who may have bought here, not mentioning any names, this is a positive sign. Okay, we don't have any data today. What is very important this week, of course, we have on Wednesday, we have Jerome Powell up in the Congress, I think normally at 10 o'clock. On the Hill, he's going to be grilled politically. And then, of course, we have CPI before that. So it's going to be pretty important to see that combination on Wednesday of CPI and what Jerome Powell has to say. We also have some bond auctions coming up in the first couple of days of this week. I think as well, what could be interesting, we might get a little bit of concession in terms of some of those bond yields going up a little bit, just making them a little bit cheaper. And then there could be some demand. So that's something I'll be looking at. Okay, guys, I'll leave it there. No doubt we'll have some headlines from Trump. So as always, let's keep our eyes open. Thank you and have a great week.